In the metals quadrant, taking a look at the July gold futures contract, the rollover from the failed attempt at a new all-time high on May 20th continues. Today, gold is failing to capitalize on some short-term momentum. It had rallied in 2 of the last 3 sessions before today, but today it dropped with respectable volume to a low of 23.1090. That was down 1.86%. That's after a high of 23.4240, which was actually a gap lower of about 0.53% from yesterday's closing price of 23.5480. And we finished the day closer to the lows, actually almost on the lows, down about 1.6 or 1.7%. Today's U.S. PPI data supported the weak CPI data from yesterday. Headline PPI month over month came in at down 0.2%, and core came in at unchanged. Year over year, PPI was lower than expected, and so was core, and even initial weekly jobless claims this morning came in much higher than expected, rising to a 10-month high of 242,000 people claiming unemployment benefits. Now, you might think that would actually rally gold, encouraging the Fed to cut rates even more than they admitted they may need to in yesterday's meeting. But yesterday, the dollar bounced when the Fed left rates unchanged because they fell short of putting a date on the rate cut. And also, they cut in their SEP, which is the dot plots or the summary of economic projections. They went from 3 predicted rate cuts this year to 1. So you look at it, and that caused a strong dollar bounce today against all the majors. And in the aggregate, the dollar's up about 0.5%, despite yields continuing lower, with the 10-year yield down to about 4.25%. This makes sense because the dollar responds more to the Fed removing the rate cut probabilities than the SEP, and yields respond more to the weaker data that I just went through, and gold responds more to its inverse correlation to the dollar than it does to its inverse correlation to the Treasury yields.